The top business stories live from the Sky News City studio. The chief executive of Coutts resigns over the handling of Nigel Farage's bank account. The European Central Bank raises interest rates for a ninth consecutive time. And British gas profits soar by nearly 900%, but its parent insists it's a one-off. Good afternoon, this is Business Live with me, Ian King. The Chief Executive of Coutts is stepping down over the Nigel Farage bank account row. In a statement, the NatWest Group, which owns Coutts, said that Peter Flavel will resign with immediate effect. It follows the resignation of NatWest Chief Executive Dame Alison Rose in the early hours of yesterday morning. The bank has been at the centre of a row sparked by the former UKIP leader Mr Farage after he said his account was shut down because Coutts did not agree with his political views. Well, announcing his resignation, the outgoing Chief Executive, Peter Flavel, said, "In the handling of Mr Farage's case, we have fallen below the bank's high standards of personal service. As CEO of Coutts, it is right that I bear ultimate responsibility for this, which is why I am stepping down." Well, in response to that, Nigel Farage tweeted to say it was only a matter of time before Peter Flavel, the Coutts CEO, stood down. "The ultimate responsibility for the dossier debanking me for my political views lies with him. I even wrote to Mr Flavel twice before going public and didn't receive an acknowledgement." Well, joining me now for more on this is Ian Douglas. He's the head of research at Spears Magazine, which is the experts in the wealth management industry. Ian, welcome to you. Did Peter Flavel really have a choice here?
No, probably not. Coutts, they're a private bank, and private banks have particular responsibility mainly in customer service. So while there are a number of banks, the big nine, high street banks who are legally obliged to provide banking services to anybody who needs it, the private banks are slightly different, and they can choose who they give services to, but that level of personal attention is exactly what they need to maintain. And if that's seen to be missing in that case, then as he said, he holds ultimate responsibility.
Yeah, Peter Flavel is regarded as having done a pretty good job at Coutts in the time that he's been there. What sort of things has he been doing?
Well, they've been there since 2000. He's been there since 2016. In that time, they've seen significant growth. And Coutts, I think, are seen as almost the high street end of private banking. They're the biggest private bank. They have an awful lot of celebrity clients. They have members of the royal family who bank there, and they are essentially the first step on that big ladder towards extremely high net worth wealth management. They're the public face of private banking, if you like, and really Peter Flavel has been instrumental in that.
And he really modernised their image. I mean, as you say, he did get a lot of celebrity customers in, but he also tried to sort of soften the image of it a little bit, didn't he?
Well, that's right. I mean, Coutts talk an awful lot about sustainability, inclusion, carbon neutrality. They have a beautiful garden on the roof of their office on the Strand. It's all, as with an awful lot of business now, it's been very important for them to present an image of being not just interested in money, but interested in the social impact of what they do and what their customers do.
And Ian, what about the overall image of Coutts? How badly damaged is it by this affair?
Well, I think really this is part of a sort of larger problem within private banking. There are these people called politically exposed persons, and there was a set of regulations introduced some time ago that meant that the banks have to look at what their customers are doing. It was originally a set of regulations around money laundering, but that's not in any way the case here. But these people are under greater scrutiny for a reputational point of view for the bank. In the upcoming bill, it's going to become illegal for a bank to fail to act when they think wrongdoing is going to might be the case with one of their customers. And so an awful lot of high net worth people are seeing themselves losing their bank accounts in the private banks.
OK, and we have to leave it there. Appreciate you joining me this afternoon. Thank you.
My pleasure.
Now, the parent company of British Gas is again the target of politicians and poverty campaigners today after a strong rebound in profits. Well, Centrica reported a near tenfold increase in half-year earnings at British Gas, but stressed it was only likely to be a one-off. The company reported an operating profit of £2.1 billion for the first 6 months of the year. That was up from £1.34 billion during the same period last year. Well, a big contributor to that was British Gas Energy, whose operating profits rose from £98 million to £969 million. The company said this was due to the energy regulator Ofgem, allowing it to recoup previously lost costs through the energy price cap. It also announced an additional £50 million donation to help support customers struggling with their energy bills. Well, in response, the energy regulator Ofgem issued a statement during which it said the profits we'll see in the energy retail sector for the first half of this year are a one-off, as suppliers recoup some of the genuine and significant costs and losses they incurred in recent years due to COVID and the Russian invasion of Ukraine. We expect profit levels to fall back significantly moving forward to the reasonable and modest levels allowed for in the price cap. Reasonable profits are important for the sector to be sustainable and provide good customer service, healthy competition and innovation. BT said today that its Openreach arm was now 44% of the way through its rollout of full fibre broadband, with 11 million premises now able to access the service out of the company's target of 25 million. Well, the news came as BT reported underlying earnings of £2 billion for the 3 months to the end of June. That was up 5% on the same period a year ago, and much of it came from Openreach due to both price increases and higher take-up of full fibre services. BT's consumer arm, which includes the UK's largest mobile operator, EE, saw earnings increase by 6%. The shares are, however, off by just over 1%. The motor dealer Lookers has agreed to a takeover by a Canadian buyer valuing it at more than £504 million. Lookers, which was founded in Manchester by John Looker as a bicycle retailer in 1908, is being bought by Global Auto Holdings, a business owned by the privately owned Canadian car dealer network Alpha Auto Group. It offered £465 million for the business last month, but that was rejected by the largest shareholder in Lookers. Well, the company trades from 147 car dealerships, selling new and used vehicles. The 35 car brands in which it specialises include Ford, BMW, Vauxhall, Volkswagen and Peugeot. Now, it's been a tough few years for active fund managers as increasing numbers of retail investors move to so-called passive investments like tracker funds and exchange-traded funds. But today saw Jupiter Fund Management report an underlying pre-tax profit of £46.4 million for the first 6 months of the year. That was up 56% on the same period a year ago. Assets under management rose by 2% to £51.4 billion. Well, joining me now is the Chief Executive of Jupiter Asset Management, Matthew Beasley. Matthew, great to see you this afternoon. You had a net inflow of funds for the first time since 2017. Is it too early to say you've turned a corner?
Yeah, well, we've been focusing on trying to grow our business internationally, as well as in some of those more institutional channels where historically Jupiter hasn't been present. And so we've had a little bit of independent growth source against what is, look, a very challenging market for active and passive managers right now, in terms of clearly the economic environment is uncertain, and many clients are preferring to leave their money parked in money market funds or simply on deposit rather than invest them in equity and fixed income funds.
So this obviously reflects the fact that you have had this strategic push into institutional and international. When can you stem the outflow in retail funds, do you think?
Well, I think it requires the economic environment to become more certain. I think what investors really need to see is an end in the rate cycle. And with that end in the rate cycle and some confidence in an economic recovery, I think you'll see investors wanting to be a bit more adventurous with their cash and to move beyond simply having money on deposit and maybe investing in equity and bond funds.
What are the kind of assets that institutional investors are seeking exposure to? I know that's a massive generalisation to
Well, it's a whole range of funds. Look, typically, institutional investors tend to have a longer-term perspective. They tend to be more willing to be contrarian, and they will see some value in both equity and fixed income markets at this point of uncertainty. Yeah, the UK equity market is a great case in point. The outlook for the UK economy is clearly quite challenged. We still have some challenges with inflation. Yet a lot of the challenges as relates to the UK economy and indeed the potential political uncertainty that comes with a change in government next year, a lot of that might be already discounted in UK equity markets. So some institutions will take that opportunity and be willing to invest now where retail investors tend to be a little bit more cautious in their response.
Obviously, there was a lot of turmoil in the gilt market last autumn post the mini-budget. Has that changed longer term, you think, the way institutional investors look at gilts as an asset class?
No, but I think gilts are part of a wider suite of fixed income products that investors typically look at. Gilts are obviously a safe haven investment, and in times of turmoil, they'll be a big area of focus for certain investors. Most investors in fixed income tend to see the wider fixed income asset class beyond gilts. I think in the short term, clearly there were issues as relates to the gilts asset class. I think they're largely starting to dissipate.
And going back to the point about retail outflows, what are the kind of asset classes that retail investors are yanking their money from?
For most asset classes, but equities particularly. I mean, UK equities and indeed European equities have been out of favour now for many years. Fixed income has been a more challenged place to be invested given the declines in that asset class over the last year as well. So what we really need to see here is some stability and underlying economics, but also we need that discount here. We need that opportunity set to be very clear and visible. And right now, as I say, with the economic environment being uncertain largely globally, most investors are preferring safer asset classes.
Why do you think UK equities trade at a discount to a lot of their international peers? I mean, we've had a huge day of corporate earnings here in the UK today, and by and large, a lot of the results have been pretty good.
Yeah, I think UK equities are unloved. And look, that might be an opportunity. And look, we as a UK-based, UK-listed asset management firm with a big presence in UK equities, we clearly would like to see that happen. So I think some of those uncertainties are going to take a while to dissipate, but I do think the discount in UK equities, just how cheap most UK-based companies are relative to similar companies in other geographies, is really starting to manifest itself. And at some point, with a more stable political environment, that gap will get closed. You will have buyers come in and favour UK equities because of that discount and that valuation opportunity.
All right, Matthew, we have to leave it there. Really busy day for your results day. We do appreciate you coming in to talk to us. Thank you. Still to come here on Business Live, we'll have a look at how the markets are doing this Thursday afternoon. Don't go away.
They've pushed the protesters further back here. There's around 200 or 300 still remaining.
I'm Dan Whitehead and I'm Sky News' West of England correspondent.
This van goes onto the streets of Plymouth 7 days a week, 365 days a year.
These facilities at the moment are a lifesaver. It's all we've got.
From fishing communities to bustling cities, we spend every day reporting from across the region, hearing from people who have real stories.
I'm gonna have nowhere to live for about 3 or 4 months.
There are still people inside the properties here.
They're coming from the epicentre of what is now a global health pandemic. We were seeing and speaking to young women who were selling themselves right on the high street. It was desperately sad, and the fact it was happening right in the heart of this community. Before Brexit, these oysters were being exported to the EU, but the trade stopped overnight.
What's your feeling about the future then?
Blake might all be finished, I don't know.
fly Emirates, fly better. Fly Emirates, fly better. Thank you.
Welcome back. Now, shares of Barclays have fallen by more than 5% after warning that its net interest margin, which is the difference between what it pays depositors and charges borrowers, pays depositors, I'll get my teeth right, will be lower than expected this year. The lender was reporting a pre-tax profit of £4.6 billion for the first 6 months of the year. That was up 22% on the same period last year, although when litigation and conduct charges a year ago were stripped out, profits were actually lower. Well, the bank's chief executive, CS Venkat, has been speaking with our sister channel, CNBC.
We've been seeing increasingly people who are responding to higher inflation, higher interest rates on their mortgages, use their savings to pay down their mortgages. I think this speaks to two things. One, it speaks on the part of our customers to their own prudent financial management. That's what they should do, right? When they're paying higher interest rates, if they feel comfortable using their savings, they should use them to pay it down. Second, it speaks to the quality of our customers. We have generally been very conservative in our lending guidelines, and we have a set of customers on margin who are able to do this.
Now, European Central Bank raised interest rates this lunchtime for the 9th consecutive time. The ECB raised its main policy rate from 3.5% to 3.75%, taking it to its highest level since 2001. Well, the move came hours after the US Federal Reserve resumed raising interest rates after taking a pause last month, also taking its main policy rate to the highest level in 22 years. Well, the oil price has traded above $84 a barrel this afternoon for the first time since the 19th of April, as concerns over supply tightness continue to be a talking point. Brent crude currently changing hands at $83.98 a barrel. That is up just over 1.25%. On the equity market, stocks in Europe have finished sharply higher after the European Central Bank indicated it may now pause before raising interest rates again. There you go, that's the current picture. Among the leading gainers in Europe this afternoon is Universal Music. The share's up there in Amsterdam by 11%. That's after it received a push from one of the brokers. Well, here in London, the FTSE 100 has finished the session ahead by just over a fifth of 1% higher. All of the leading gainers are results-driven. They're led by Centrica, which finished ahead by some 7%, while RELX, whose chief financial officer we had on the programme this morning, has finished ahead by 4.5% on its results. Also reporting today and also ahead, Airtel Africa and Informa, both of those up by just north of 4%. To the downside, the wealth manager St James's Place is off 15% on its results, while Barclays was another one that disappointed with its results there. The shares off 5.25% at the close. Outside the FTSE, again, it's all results-driven. The motor dealer Inchcape, that's finished ahead by more than 8.5%. To the downside, Mobico, that's the new name for National Express, that's finished off by some 9.5% lower. On Wall Street, stocks have risen on news that the US economy grew at an annual rate of 2.4% in the second quarter of the year, representing an improvement on the first quarter. That was 2%. Meta, the standout feature this afternoon on Wall Street, ahead by some 7% after last night's results. On the foreign exchange markets, well, the euro has sold off somewhat after the ECB statement. As you can see, the euro off by nearly a third of 1% right now against sterling and off by 0.75% against the US dollar. The pound, meanwhile, is off by just over half of 1% against the greenback. Well, joining me now is George Ligarius, the chief economist at Mazars. George, good to see you again right now. Tell me about the ECB. I mean, it looks as though they had little choice given where Eurozone inflation lies, but it looks like they're giving themselves room to take a pause next month.
So the ECB would generally tend to be naturally dovish because it has a problem. It has a lot of countries that have low inflation, countries like Greece, for example, that has inflation around 2%. And it has countries that have inflation over 6 and 7%, and they only have one interest rate to deal with it. So they would tend to be naturally dovish. They would tend to follow rather than lead in terms of interest rates, because it's very difficult to help all those economies with one singular interest rate.
It is. We are in a really sort of uncharted territory for the ECB, though. I mean, the last time its policy rate was this high, euro notes and coins hadn't even been distributed.
That's the point. And, Lagarde is showing genuine leadership, make no mistake about it. But it is a very big test for the cohesion of the Eurozone.
Now, what about the United States? The GDP numbers were much better than expected, better than the second quarter. The Fed said last night they don't expect a recession now this year. What does that mean? What's the read across there for US equities?
Well, there are two sides to that coin. Yes, consumption was decent and there was strong investment and there was a buildup of inventories, which have really fallen down. So, there are those seasonal elements. But that also means a much more protected period of higher interest rates. We can't have, in markets, we can't have our cake and eat it too. Good economy is a great thing, but also that would mean a prolonged period of peak interest rates.
And that was very much the takeaway from what Jay Powell, the Fed chairman, was saying last night, wasn't it? Rates may not have to go up much further, but they're not going to come down anytime soon.
Yes, I mean, you could have one more rate hike, but when markets are concerned, this is history, although it hasn't happened yet. The question is, how long are they going to remain that high? And personally, I'm in the camp of those who believe that we won't see a rate cut until the back end of 24 or even the beginning of 25.
Well, really, that would be quite sensational, particularly given we've got a US presidential election next year.
Well, yeah, but theoretically speaking, the Fed is impartial to all of that. And by the way, what the Fed wants is a stable economy ahead of that election. It doesn't. The interest rate would probably be less of a concern.
Yeah, you're absolutely right there. I mean, obviously, we're in the thick of earnings season. Massive day for company earnings across Europe today. But before we talk about that, what about the United States? Any of the company updates today caught your eye in particular?
Well, Meta did very good, obviously. Banks were decent. The number I really want to talk about is -7% to -9%, where we expect earnings to land by the end of this quarter. And this is not a great number. Okay, we hear Meta, we hear the good news, but overall we are talking about a general drop in profits. So we should be mindful of that. This is not a great earnings season. And, the reason most companies outperform is the usual, that expectations have been downplayed. And that's a good boost for markets over the short term. But overall, it's not a great earnings season.
George, which of the sectors that you see is coming under pressure? Because, as you say, expectations have been downplayed in a lot of businesses. GE yesterday, good example, surprise to the upside.
Yes, well, it's not a very difficult game to play because, in essence, we have a trending market and somewhat positive market. I wouldn't call it a bull market, but definitely an upward market. So it's easy for CFOs to downplay expectation. They know that it might, when they do, it might not wreak havoc with the price. And then when the actual earnings come out, then they get they get the boost. So it's not too difficult to use that tactic these days. In terms of sectors, generally speaking, the economy, both services and manufacturing, doesn't have a bright outlook, and the number might have surprised to the upside, but take out inventories and you might have a different picture. You rebuild inventories, but you can't rebuild them again next quarter. So I'd say I'm not overly positive across all sectors. Mostly in manufacturing, we see low demand across the board. The PMI indicators have been suggesting that for some time, and now we see services slowing down. Energy prices, you were talking about energy prices before. Yes, there's been an uptick, but there can't be many more production cuts because Saudi Arabia budget is already suffering and the Russian budget is already suffering. So there's only so much OPEC Plus can do.
Absolutely, and worth noting, George, of course, that the fact that Brent crude is back above $84 a barrel this afternoon.
Yes, my general point, however, is that we should not expect massive rate cuts from these countries. So, you know, there is obviously the trading that's going on, but overall, I would not be, despite the uptick in prices, I would not be overly optimistic about the energy sector going forward, especially
OK,
as
George, we've got to leave it there, I'm afraid. Thanks, George. Good to see you. Thank you. That's it from me. I'm back at 11:30 tomorrow morning. Hope very much to see you then. In the meantime, do stay tuned. After this short break, it's Mark Austin. Cheerio.